The local labour market surges, keeping the unemployment rate at a 48-year low. ANZ under fire for its stance on climate change, and Qantas promises lower airfares, but not until next March. It's Friday, the 16th of December, 2022. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. Big day in Canberra yesterday.
It certainly was. You know what, Sean? I wish that it was the lowest unemployment rate for 50 years. I know 48 years is impressive, but wouldn't it just be so much easier if we could just say, this is the lowest unemployment rate in half a century? Instead, we have to actually qualify it and say, oh, no, it's actually 48 years.
You know, if I was rewriting this, I'd just go half a century now.
Just round it up.
I mean, it's close enough. Yeah,
just round
absolutely.
it up. I mean, I think that's the approach they take at the Bureau of Statistics. Just round it up.
Ooh. Actually, do you know the Bureau of Statistics? I reckon that is one of the most improved organisations in the past couple of years. The quality of their data, their website, the whole lot in the last 3 or 4 years has improved out of sight. Only other organisation that I think is better is Services New South Wales. I think that is like unparalleled in how much that's improved in the last decade. But ABS, a real shout out to the ABS.
Do you think we need to introduce the Fear and Greed end of year awards, and most improved goes to the ABS?
Yes.
Highly commended goes to Services New South Wales?
Yeah, no, I like that.
I can't imagine it's going to take off, but no, we'll have some fun with it. We've got an interview coming up today, Sean, with Sam Hallinan from Schroders Australia.
Yes, Schroders has undertaken a survey around investor attitudes, given rates are rising. It's really interesting to see how many professional investors, how many investors that do it for a living are now going to financial advisors for help. Also, we have a great chat about how financial security and financial advice can help with mental health. Really fascinating interview.
Yeah, it's a good one. It's coming up a little bit later on. But the main story this morning, Sean, the Australian economy put on another 64,000 jobs last month. That's well above expectations. And the unemployment rate came in again at 3.4%. As I said, its lowest level in 48, nearly 50 years.
In almost half a century, the unemployment rate hasn't been at these levels.
Well done.
It's certainly a very hot labour market, and that matters because when people have jobs, they spend money and keep the economy ticking over. They're also more likely to be confident about the future given they've got employment. Now, consumer confidence has been hit hard by rising interest rates, but there have been signs that it might be turning. Yesterday, Employment Minister Tony Burke welcomed the numbers, but said there was still a long way to go to improve wages.
All right, a little bit of a lesson here for me, Sean. Why did the unemployment rate not fall lower than 3.4% when there were so many new jobs created?
So people looking for work, as measured by the participation rate, rose to a new high of 66.8%. So we have more people looking for work than ever before and a record low unemployment rate. That is quite the market. Underutilisation measures, which looks at whether people are able to get as much work as they want, they're at 40-year lows. Quite incredible. People are getting all the work they want. Interestingly, the Australian Bureau of Statistics noted a high level of overseas arrivals, particularly students. That's helping lift employment.
Sean, the question I seem to be asking most days now is, what does all of this mean for interest rates?
Well, that's the bad news. It adds to pressure for higher interest rates because a strong labour market eventually will lead to a jump in wages, which of course is inflationary. At the moment, wages growth is a little over 3%, and that's probably heading more towards 4% sometime next year. In a sense, the labour market is probably too strong. The Reserve Bank has two main objectives in life: keep prices stable, keep inflation at 2 to 3%, and maintain full employment. It looks like the central bank is currently overachieving on the latter, the employment side, and underachieving on the former. Now, those two things, inflation and employment, tend to go in opposite directions. The way to change the overachievement in employment and underachievement in inflation, at least if you're the Reserve Bank, is to lift interest rates.
All right, so big day yesterday. Did the employment data have much of an impact on local markets?
Well, the S&P ASX 200 fell early, then the data came out and it surged to its peak for the day, and then it fell back and finished down 0.6% to 7,205 points. Lithium stocks led the way lower, more of that in a moment. Among the large caps, there wasn't too much going on. Macquarie Group was the worst of them, down 1.6%, while Wesfarmers and Aristocrat Leisure, the gaming machine manufacturer, dropped more than 1%. Coles was the best of the big stocks, up 1.4%. Now, best on the day was Vitamins Group Blackmores. Vitamins Group Blackmores, up more than 7%, while the coal companies also did well.
I'm so glad you pulled yourself up on vitamins just then. I was like, oh, please, if you don't do it, I'm going to have to. So well done.
It is one of my least favourite words, vitamins. Vitamins, fine. But you know when people say vitamin, I think it's an English pronunciation, to be honest.
And you know what it reminds me of?
The
way you pronounce tacos.
Tacos.
Sorry, I figured I'm running out of time to get that in one more time this year. So I thought I'll get it in today, then at least it's done. Tick that one off the list. Carry on.
Corporate news, a little bit of that around yesterday. Supermarket giant Woolworths, it's certainly been busy. On Wednesday, it said it sold down its interest in Endeavour Group. Yesterday, it said it's agreed to acquire a 55% equity interest in specialty pet food accessories and services retailer Petspiration Group. It's costing Woolies $586 million, but that is a growth sector of the economy, looking after pets. Elders boss Mark Allison said the huge drop in the agribusiness company's share price following the announcement that he was leaving the company is a gross overreaction. Now, on November 11, Elders lost about $475 million in value when it was announced that Allison was stepping down. He came out yesterday and he said, well, 5% would have been a compliment, 23%, and that's a bit of an exaggeration. Anyway, notwithstanding the 3% plus rise in Elders' share price yesterday, it has remained at those low levels ever since the announcement. Appen CEO Mark Brayan will step down after a tough year for the artificial intelligence data services company. And finally, ASIC has commenced proceedings against Finder.com, or a subsidiary of Finder.com, for allegedly unlicensed conduct and inadequate risk disclosure over one of its crypto asset products.
Okay, what's going on in international markets?
All the news over the past 36 hours has been around the Federal Reserve's decision to lift US rates by 50 basis points and the commentary with the change that made it clear there are more rate rises in the offing. That pushed shares lower and the US dollar higher. The Aussie dollar against the greenback is currently trading a bit above 68 US cents. One Wall Street company worth noting is Tesla, which yesterday closed with a market capitalization below 500 billion US dollars. That's $500 billion US dollars. For the first time, though, since November 2020. So far this year, it's lost 55% of value, mostly because it's considered a relatively risky stock compared to other large caps. Now, Chief Executive Elon Musk's focus on Twitter hasn't helped either, nor has the fact that Mr. Musk said he'd sold $3.6 billion worth of Tesla shares. Quick mention to New Zealand. Figures yesterday show the economy grew at an 8% annualised pace during the September quarter. No wonder they're lifting interest rates there.
Yes, indeed. All right, plenty going on. We'll be back in a moment with the rest of the day's business news. Sean, many of us, when taking a new job, probably think relatively little about the superannuation component and are almost happy for our 10% to go to whichever fund our new employer wants to send it. But the Prudential Regulator has revealed that about 800,000 people are currently in funds delivering significantly poorer returns.
Yes, the annual Australian Prudential Regulation Authority table of poorly performing default super funds, it's quite the name, isn't it, was released yesterday. An energy industry superannuation scheme took out the unwanted title of worst default product. At the other end of the spectrum, UniSuper was the top performer. If you want to see where your fund came, and I suggest you do, go to apra.gov.au. Now, APRA's been running what it calls heat maps in an effort to weed out poor performing funds and improve competitiveness. Since inception, fees and costs have fallen for more than half of members' accounts, saving in total around $210 million. That's good news. 28 MySuper products have closed since APRA began the heat maps.
I mentioned this one at the top of the show, Sean. ANZ held its annual general meeting yesterday, and like the other major banks, it came under fire from climate activist shareholders.
Yes, one group, Market Forces, claimed that the chair of the country's fourth largest bank, Paul O'Sullivan, deliberately misled the AGM by misconstruing the basis for a shareholder resolution relating to lending to the fossil fuel industries. Now, ANZ is the largest lender to the resources sector among the big four banks, and according to the Financial Review, last month said it will allocate more capital to heavy emitters for the energy transition. Market Forces lodged a resolution asking ANZ to justify how lending to expansionary fossil fuel projects is consistent with the bank's commitment to net zero by 2050.
Sean, the ASX Limited is under the gun with the Reserve Bank and ASIC using special powers for the first time to increase oversight of the organisation that oversees the $3.5 trillion equity market.
That's right. We spoke yesterday about the government introducing new rules around the ASX, but the powers invoked yesterday were already in place. The Australian Securities and Investments Commission will be able to issue notices to the ASX that require it to produce a special report on the capacity and security of the existing CHESS clearing system. ASIC just wants to make sure the system's working and they want to make sure it's reliable. For its part, the Reserve Bank has forced the ASX to give a public undertaking that it has the resources and capability to support the system, and it's forced the company to take a more consultative approach. The fact that regulators are invoking these powers just demonstrate how worried they are. The CHESS replacement system, which cost ASX $250 million over the last couple of years, fell over. It never actually made the playing field, and I think they're going back to the drawing board on that, and the regulators are just worried.
Sean, the federal government's energy bill passed the lower and upper houses yesterday. It's really a victory for the Albanese government on the last day of Parliament before the Christmas break.
Yes, Prime Minister Anthony Albanese said the bill struck the right balance and the cap on gas prices will only affect a small number of contracts. He was critical of the opposition for not supporting the legislation, which of course caps prices, introduces the code of conduct for the industry, and includes $1.5 billion to help low and middle income households. All week we've been discussing it. The Greens ended up supporting it. Several of the crossbenchers ended up supporting it. The gas industry didn't like it. The gas users loved it. And Mr. Albanese, well, he's pretty happy this morning.
It's been a bad few days, Sean, for lithium stocks, which not so long ago were the absolute darlings of the market.
Yes, lithium prices are around 7-week lows at the moment on expectations of lower demand due to a global slowdown. Also, there's more stable supply coming online. Mind you, prices are still very high. Anyway, the share prices of the local producers have dropped sharply. Pilbara Minerals led the lithium stocks lower yesterday, falling 11% after its latest auction attracted a lower than expected price. Core Lithium tumbled 8.6%. Liontown Resources was off 7%. Alchem was 5% lower. IGO dropped 4%. Incredible what a sell-off there has been in that sector. And just as an aside, Michael, lithium explorer AVZ Minerals has been suspended from trading since early May. Yesterday it came out and said we're going to remain suspended until January 31. Basically, the company said the suspension is necessary until it gets an update on its mining license in the Democratic Republic of Congo. It is sitting on a deposit there, which is supposed to be one of the biggest in the world. So it'll be interesting to see what happens there. Lithium, of course, is very hot. Everyone loves it. Australia is the second largest owner of lithium deposits. Guess which country is the first, Michael?
Oh, I knew you were going to ask me this. As soon as you said the second largest, I'm like, here comes the question. I'm trying to stall while I Google this. I can't find the answer. China?
I was going to say it starts with CH.
Was it China?
No, Chile.
Oh.
There you go.
Okay. Well, thank you. I should have Googled harder. All right. Next time, let me know. You start at the start of the story and just say, look, just at the end, I'm going to have you, going to give you a trivia question. So I'll have Google up and ready to go. Not that I'm cheating or anything. I just need a bit of assistance sometimes. Now, the story that I've been waiting for, Sean, is all about Qantas. And yesterday, the airline said that it's going to lift capacity, which should then put downward pressure on airfares. But it isn't actually going to happen until March next year.
Yes, March at the earliest, could be April. The airline said it would add a further 57 return services on the Golden Triangle, which of course Brisbane, Melbourne, Sydney. There'll be more seats on its flights to and from Perth. Now, Qantas says operational challenges, think delays and cancelled flights, have broadly been addressed and hence the ability to increase flights next year. Do you remember the story earlier in the week where the ACCC, the competition regulator, warned Qantas and Virgin that they needed to increase capacity? Funny, 2 or 3 days later, Qantas is doing it. Jet fuel prices, they do remain high. That's a real problem, though they're down about 20% since early November, according to the International Air Transport Association. But that certainly is pushing up costs and also adding to the equation about how many planes to fly. Also, Virgin will commence flights from Cairns to Japan. Now, the private equity-owned carrier will operate new Boeing 737-8 MAX jets, and it'll offer about 2,000 seats per week. It'll certainly be the longest haul route in Virgin's schedule. Anyway, the upshot of all that, more planes coming on, more capacity should push down prices, just not for a little while.
Okay, it is good news, just slightly delayed good news. All right, moving on to overseas news now, and China's economic activity worsened last month ahead of Beijing abruptly dropping its COVID-0 policy, and more disruption to growth is likely as infections surge.
Yeah, so the health of China, and pardon the pun, is important to the Australian economy. Figures yesterday showed a big drop in retail sales last month, while there was a slowdown in industrial production. Investment also weakened, while the jobless rate climbed to 5.7%, the highest since May. The whole idea of dropping the COVID-0 policy is to kickstart the economy. Problem is, in the short term, so many people will catch COVID. And remember, the vaccines in China aren't as effective as those in Australia, in the US and Europe, for example. And so you may actually have more of a slowdown in the short term.
Okay, last one. US authorities have charged 8 people in a social media pump and dump stock scheme where they earned $100 million by allegedly ramping stocks.
Yes, now this is the 2022 version of Wolf of Wall Street, the modern day version. The Securities and Exchange Commission alleges that from early 2020 to April this year, the men, who had a combined following of 1.5 million on Twitter, ran a pump and dump scheme promoting themselves as successful traders and encouraging followers to buy certain stocks. Then, as prices rose, they'd sell the stocks without disclosing their plans. Sounds a bit familiar, doesn't it, really? Moral of the story, and we've said this many times, get some professional advice before investing. Simple as that.
Seems a very good way to finish up today's show, Sean. Up next, you've got the Fear and Greed Daily interview with Sam Hallinan from Schroders Australia.
And we're talking all about using financial advisors to invest, particularly when interest rates are rising. Yeah, it's a great chat.
Oh, it's almost as though we planned that.
Almost.
All right. That's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Friday, the 16th of December, 2022. Make sure you're following the podcast and join us online on LinkedIn, Instagram, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.